Have you ever wondered how to analyze a rental property to tell if it's a good deal or not? Well, in today's video, I'm going to break down one of the most important terms you'll need to understand and how to use it in order to invest in real estate deals. Hi, I'm Dr. Jeff Anzalone, a Louisiana periodontist and passive real estate investor. If you're new here, this channel is all about helping you achieve financial independence in 7 years or less with passive income streams. Be sure to hit the subscribe button and bell so you don't miss a thing. Now, during dental school, I had to learn a whole slew of different new terminology, such as mesial, distal, and occlusal. And when I first started learning about real estate, I realized that many people initially are thrown off by all the different new terms that they also must become familiar with, such as NOI, COC, and what we're going to discuss today, cap rate. Now, understanding how to evaluate investment properties all starts with understanding these right calculations. Now, I don't recommend that you start investing until you really understand the numbers and how to factor the cost and potential gains. When I first started investing in multifamily syndications, this term cap rate was tossed around a lot. So I naturally wanted to learn why it was so important. Why was everybody saying it? The good news is that if you're a passive investor like me, you don't need to learn and worry about making every single little calculation for each deal, but you do need a basic understanding of what they are and what they mean to help you to determine your level of risk. Now, let's briefly get into exactly what a cap rate is, how it's calculated, what it's used for, and perhaps most importantly, what you need to know about them as a passive investor in syndications. All right, let's get going. First, let's talk about what exactly is a cap rate. Well, cap rate is used commonly in commercial real estate to indicate the rate of return that a property is expected to generate. So, the rate of return a property is expected to generate. Now, it's based on a ratio of the current income to the market value of the property. Now, you may hear people say that, hey, I'm going to go look at this property. It's got a cap rate of 6%, or that assets in a given area are trading around about a 6 cap. And this is what they mean by that. So let's talk a little bit about exactly what they're talking about and how these people arrive at those numbers. So it's only fitting that we go through a very simple calculation. So let's start off with the formula. So to calculate the cap rate of a property, you simply divide the NOI, or that's the net operating income, by the value of the property. And this will give you the cap rate. Now, one thing that you may notice in this calculation is that this particular formula, it does not take into account any debt. So regarding mortgage or interest payment, anything like that. So excluding the debt in this formula, when you calculate this, it's part of the reason why the cap rate is so useful in determining whether or not you should potentially buy a property or not. And really, this formula is focused on the property alone and has nothing to do about the financing used to buy the property. So let's go over a quick example. So let's say you're looking at purchasing an apartment and the purchase price is $1 million. This property brings in $100,000 in income. The operating expenses is $50,000. So our NOI, or our net operating expenses, we take that by subtracting $100,000, the income coming in, rent, that sort of thing, minus the expenses, and that's how we come up with our $50,000. So taking our formula NOI divided by value, we can come up with this. So the NOI on this property is $50,000 divided by the value of the property. It's $1 million. So this gives us a 5% cap rate. Now, if we purchase this property outright with $1 million in cash right now, remember, this doesn't take into account debt or anything like that. So if we were to purchase it with cash right now, we could expect, according to our formula, $50,000 in net income over the course of the year. Okay. And this is basically on this investment, this is the ROI on our investment, $50,000. So by knowing this 5% cap rate, we now know that it would take, 20 years of $50,000 to recoup our $1 million investment. Okay. Now here's a different scenario. So let's use the let me get an eraser and let's use the same example. And we're going to stick with the $1 million property price. We're going to go with the same expenses. And what we're going to do, we're going to change this income to $150,000. All right. So $150,000 annual income, same expenses. So in order to get our cap rate, we have to calculate our NOI. So 150 minus 50, this NOI changes to 100,000. So then we have 100,000, which is our NOI divided by our million. So now what do we have? We have a 10% cap rate. So not really hard to figure that up once we have all the numbers to plug in. So in this particular case, it would actually take only 10 years to recoup on the original $1 million investment, which theoretically is a better return on your investment. Typically, a higher cap rate means that you're getting a better deal because the investment is generating more income for the amount that you're actually investing in the property. And a lower cap rate generally means that you're paying more and getting lower returns. So let's talk a little bit about how cap rates are used. Now, some investors, again, they put a lot of weight into these cap rates. So for instance, they only look at properties that say maybe have like a cap rate of 8% or more. However, remember, keep in mind that a cap rate, you've got all these different calculations out there to look at and figure out and to know about. And the cap rate is just a very single point of measure at any one given point in time. They don't take into account leverage, which is any loans that you're taking out to purchase the property, or they don't take into consideration the time value of money, because it assumes that we're getting all these returns at one point in time, nothing into the future. And they're most useful when really comparing different properties in a given market. So let's say, for example, you're looking at a particular apartment complex, maybe to invest in your area, and let's say that it has a 7 cap. All right, you're looking there, and then you're looking at some of the other buildings in the immediate area, and you actually see 3 additional properties with cap rates of, let's say, 6.7%, let's say 7.2%, and then you've got another one that's around 7.5%. And the one that you're looking at is 7%. So this tells you that the building that you're actually looking at, it's, 6.7, 7.5, 7.2. It's fairly in the middle, and it's fairly comparable to the returns and the purchase prices of the other buildings in the area. Okay. Now on the flip side, if you notice that most of the properties in the area of this building is around 4%, then maybe you should kind of proceed with caution. And at this point, it should make you ask yourself, wait a minute, why is this selling for such a low price? Why is it, the one selling for such so price in comparison to the amount of income it can generate? Maybe there's something wrong with the property. All right, let's talk about what's a good cap rate for a rental property. Now, again, this can be a very difficult question to answer because it depends largely on the market that you're in, as well as the different specific goals that you have as an investor. These rates can also be a good measure of the asset class and the corresponding risk. Sometimes they become synonymous with risk evaluation because, a lot of times, and these are the different definitions that people have. So this is why they associate them with risk. Typically, assets with higher cap rates, they tend to be in more developing areas. And because of this, they come with typically an increased amount of risk. Okay. Something with the high cap rate in a developing area, high risk. Could be new construction, could be, that sort of thing. Now, generally assets with a lower cap rate, they tend to be in more areas, more stable areas. Often, people want to move into these areas. There's a big demand to move into these areas. So they can actually in turn command very high prices because what? Everybody wants to move there. That's why you often hear about cap rates getting compressed or cap rates getting lower in hot markets such as the San Francisco Bay Area. In these particular areas, everybody's wanting to go there, demand's high. Because there's so much demand, people are willing to pay higher prices in exchange for lower rates of return, thus driving the overall rates in that market down. Now, with anything else, it's going to boil down to you and what's best for your investment comfort level. Now, you've got to identify for yourself how much risk you're comfortable taking on. Remember, lower cap rate, it's going to be higher price, but it's also going to have a lower risk because, again, it's an area where people are wanting to go into. Now, there's all kinds of articles and videos and books, everything around there about talking about what's a good cap rate. And I would say, looking at all the research that I've done, the general consensus seems that a cap rate between 4 to like 9 to 10% is typically considered a good investment. But bear in mind that whenever you're deciding on which real estate investment you should invest in, there's really no single metric that's going to give you all the information that you're going to need. Hopefully that explains a little bit about cap rate, and you're able to now, once you start looking at your properties to invest in, you have a little bit more knowledge about exactly what that means for the particular investment and the surrounding area. Now, also, if you want to see behind the scenes and check out my entire investment strategy, which includes these syndications that we spoke about today, you're in luck. And what I've done, I've actually opened up my books to show you everything, everything in my process that I invest in, which is going to help me, which will help you on your way to financial independence. If you want to check that out, you can head over to this video where I'm going to walk you through my investment strategy. And you can use the same thing if you want. If not, modify it however you like. I'll see you in this next video.